BII, or CDC, as it was known before, was the world's first development finance institution. We were founded in 1948. Everyone saw how much damage to real people's lives could be done by this excess of a relatively small number of people within these rather esoteric financial markets. When you come into the sort of philanthropic world, I feel like the first thing you realize is just how difficult what they do is. I mean, I think there's a naive sense, particularly in the commercial world, that it must be really easy giving away money. We're not in the business of giving money away. The role of the DFI is really to provide the capital to help the private sector to grow. It's providing capital in places and to companies that wouldn't necessarily have it. And the remit of a DFI is to make a return and then recycle the money over and over again.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Nick, it's really nice meeting you. Thanks for coming on the show with me today.
Thanks, Scott, for the invitation.
I want to start with your origin story. You were born in Liverpool, but your parents moved to Ireland when you were just 2 years old. What was the catalyst for that early family move across the Irish Sea? And when you reflect on your childhood in Ireland and your family dynamics, maybe the conversations around the dinner table, were there seeds being planted that might later grow into this passion for using money as a force for good?
Yeah, so you're right. I was born in Liverpool. My father was Irish. My mother was English. So my father had actually grown up in Ireland, had been educated in Ireland, and in common with many Irishmen at that time had gone to England to sort of broaden his experience. He was a doctor. And so they met when they were both working in the same hospital in Liverpool. So that's sort of how I came into being. And then when I was about 2 years old, my father had the opportunity to get a consultancy job in Dublin. So he to relocate the family back to Dublin. So that's how I ended up growing up in Dublin. Your question about whether there was anything in my family life that sort of led me in the direction, sort of career direction that I've ultimately gone on. My father was a doctor. My mother was a social worker. I think when you are in a medical family, there's something about the contribution that the medical profession and doctors make. And I remember being at home and seeing at Christmas, lots of parents would come to the door. My father was a pediatrician. I would come to the door with presents and they would tell you how your father had saved her child's life or whatever. And I think that does leave an impact on you, that you recognize from a very early age that perhaps life and career is about more than just being successful and making a living, and that making a broader contribution is important and fulfilling. So I think that did leave, in my particular case, I think that did leave an impact. And although I didn't follow a medical path throughout my banking career, there was always this sense that although I enjoyed it very much, I felt like I was in part of the financial services sector at a very interesting time with very good firms. But I always had this ambition or this feeling that at some point in my life, I wanted to be able to walk away from that and do something that was frankly more worthwhile.
I would imagine your mother being trained and practiced as a social worker had to play out in day-to-day, daily life experiences, no?
Yeah, I think it gave her a perspective that she passed on to her children.
Fast forward to university and you choose mathematical economics and statistics at Trinity College in Dublin. Now, I'm a guy who barely made it through my stats class. I do know what that is. Walk me through that decision. What exactly is mathematical economics and why Trinity College in Dublin other than you can get your laundry washed on the weekends, maybe?
Why Trinity College? Because frankly, at that time, this is the late 1970s, everybody who grew up in Ireland went to university in Ireland. Trinity was the best university, or the most reputable university in Ireland. I just loved math. I felt like I was good at it and I enjoyed it. And so I wanted to do something mathematical, or something which had, I suppose, mathematics at its core. I really probably should have been an engineer. I mean, that was the other alternative, I think, that felt like too much hard work. I was particularly interested and had enjoyed my sort of work in statistics and probability theory and so on, which we did a little bit of in school. And so I was interested in economics. This was part of the economics school. It was a major within the economics school. I don't think I got an enormous amount of guidance or It just felt, as I looked at the various curriculums, I said, what might I be good at? What might I enjoy? And so I lighted on this. I must say, I did particularly enjoy the statistics part of it, and probability. That has been big in a whole host of different ways, become enormously important in the world. The economics piece, the mathematical economics piece, I found somewhat dry and less interesting. I did some mainstream economics as well as part of that. So I did a development economics course, I remember, which I enjoyed very much. And I enjoyed for the broader macroeconomics rather than the sort of mathematical economics part. But that is the degree I did.
What is mathematical economics? I'm not sure I've even heard that term.
So it's basically the use of mathematical models to forecast economic factors. To some extent, it's been somewhat devalued because it makes certain assumptions around a perfect world and has been to some extent replaced by a more behavioral economics, which is more sort of attuned to how the real world actually works than the perfection that is implied in econometric models.
Yes, I guess we've proven conclusively we're not living in a perfect world.
Exactly. Yeah.
So then you get out of Trinity and you go straight to an MBA in America at Wharton. A lot of people work for a few years before going to business school, but you went straight through. What motivated that decision to go directly into an MBA, and why America and why Wharton specifically?
That's a great question. And I wouldn't recommend anybody to go straight from undergraduate school to business school, particularly somebody who wasn't really coming from a business background and didn't have any business experience. I did it to a large extent because at the time, the environment in which I was living in Ireland, this is the late 1970s, Ireland was very economically depressed place, as was most of the UK and much of the world. The opportunities available to somebody graduating, and as I was in sort of economics and statistics, were extremely limited. You had the option potentially of joining one of the accounting firms and getting an accounting qualification. Past that, there really was very little. None of the bank training programs, consulting training programs that we see now for undergraduates, company graduate schemes, very limited, particularly in Ireland, very limited. I had there was a professor I knew who had been at Wharton, had encouraged somebody who was a couple of years older than me, whose family I knew, to go to business school. And just so I said, you should think about this. So I looked at it and said, well, this would be fun. I've never been to the United States, so I could do this. And the only basis upon which I could do it was if somebody else paid for it. And then this particular individual, who was a couple of years older than me, had managed to get a job teaching at Wharton, teaching statistics. He had the same degree as I had. I just thought, well, I'll apply for this business school. It's the only business school I applied to, and I'll apply for his job effectively because he was rolling off. So I was lucky enough both to get his job, which maybe that was more logical in the sense that he'd done a good job and that I was another person from the same stable. So they were prepared to take a chance on me. But why they let me into the business school, I have no idea. But having got in, having been accepted and having had this job as a teaching assistant, which was effectively going to pay for the whole education over 2 years, and having had as an alternative a job in a accounting firm for 3 years doing more exams and audits of whatever, I just decided the US option looked like a lot more attractive. It wasn't any sort of great life plan or anything. It was just benchmarking one against the other. It just seemed like this is do something different and take this opportunity when it's available. So that's how I ended up at Wharton.
Then you get out of Wharton in 1981 and then land your first job at Goldman Sachs. And you start your first step of several steps of what turns out to be a successful iBanking career. But you are at Goldman, one of the big banks in America. This is the early 80s, and we're getting into full Gordon Gekko era. This is greed is good, Wall Street, peak culture. So what were you doing there, and what was that actually like?
Well, I couldn't understand why I got accepted into the MBA program at Wharton. It was even less logical for Goldman Sachs to hire me into what was then the equity trading program, because really I knew little or nothing about financial markets other than what I had picked up in a couple of business school courses. I think today's younger generation, they are much more attuned to financial markets and how they work, who the participants are and so on. Many of them have found ways to invest themselves. I had none of that background. So I had some extraordinary good fortune in terms of getting into Goldman Sachs, partly because it was a particular partner, I think, who, for whatever reason, was always less interested in what you knew and more interested about what your sort of backstory was. So I think he took, a shine to me. I had an extraordinary interview process where I was asked to talk about what my favorite stock company was, and I had no idea. So I talked about this company that I had.
This was in New York now? Was it?
Yeah, this is the famous Goldman Sachs training interview process in New York, where they get you to be grilled by all these different people over the course of the day. One of them asked me what my favorite stock was. There was a company I'd done a little bit of work with on a business school project, so I was able to talk a little bit about what they did. It was very early days of biotechnology, and so I talked a little bit about that. And then he asked me what the stock price was. I had absolutely no idea, other than to know that this is probably more detail than you need, but this company, which is a company called Genentech, which is at the time were well known. IPO went public at 40. I knew it had traded up to 80 on the first day, and I knew it had traded down after that. That was my limited knowledge. And so then the guy asked me to tell him what the price of the share was yesterday. And I had no idea. This is the days before, obviously, mobile phones or even computer terminals. So I didn't know. So I did the worst thing I could possibly have done. I guessed, which was in retrospect, there was a huge mistake. I would have been better off saying, I just don't know. But I guessed that I guessed 60, knowing it had come public at 40, gone up to 80, and then traded down to 60.
That's where the mathematical thing came in. You just take the number in the middle.
Yeah. So the guy leans forward. There's a Wall Street Journal sitting on a little sort of side table in the room that he was interviewing me. He picks up the paper. He opens it. If he'd given the Wall Street Journal to me and asked me to find the stock price, I wouldn't have known where to look. Anyway, so he does that, and he folds it and he puts it down. And I sort of say, I couldn't resist. I say, okay, Bill, so where did it close? And he looks at me, he sort of smiles, 60 and an eighth. That's what, okay. So, I mean, when I talk about getting into Goldman's, I was very lucky, and they should never have hired me, but they did.
Where did you initially land? Were you in trading?
I joined the sales and trading program. So I was in the equity business. So my initial exposure to financial markets was through sitting on the trading floor in Goldman Sachs.
And this is, as I said, the early 80s. What was it like being inside the machine at that point?
I was very lucky in terms of my timing, because I think I came out of the training program in the summer of 1982. And if you look at the charts of the S&P or the Dow Jones, you'll see that it really bottomed in August of 1982. So just as or shortly after I came out of the training program, the market just sort of took off. At the time, Goldman Sachs was one of 5 or 6 really what they call bulge bracket firms on Wall Street. And so we had this long period of really fantastic market growth. It was definitely a sort of, and not Goldman Sachs. I mean, when you look at these movies like The Wolf of Wall Street and all these things, they don't represent what I was part of in a highly reputable firm. But certainly there was sort of an animal spirits that existed at that time throughout the 1980s, which is for a young person, was a very exciting thing to be part of. You never thought about this whole idea of, I mean, now we think a lot, and we'll talk, I'm sure, about the impact that investment has, awareness that society has, that the decisions that we make around how we allocate assets, how we make investment decisions have a real impact on people's lives. And we should look at those and think about them, measure them. And that notion just didn't exist. Of course, financial markets were also a lot smaller. I mean, I think a lot of the impact investment, the catalyst for the impact investment movement came out of the 2008 crash, actually. And that awareness that how much damage financial markets could do.
I can commiserate with you on all of that. I think we're close to being the same ages here. You ended up at Goldman, I think, in total around 15 years. And we're in New York and Zurich and London. I'm not sure if the order's right. Tell me about your progression. You started out on the desk, but you didn't stay on the desk all that time, did you?
Quite quickly gravitated into management after about 5 years or so. Well, first of all, I went through this training program in New York. I got sent to Zurich. I went to interview. After that day, I was interviewed at Goldman Sachs. I remember they called me back the next day and said, well, so we enjoyed talking to you. We'd like to continue the discussions. Originally, and all my discussions have been about going back to London because I didn't have a visa to stay in the United States. And they said, well, but we were wondering whether you'd be interested in one of our other European offices. Fortunately, I'd read the annual review of Goldman Sachs. So I said, well, I think the only other place in Europe that you have an office is in Zurich. And then I remember saying to the guy, I think I've never been in Zurich, I think they speak German there. I don't speak any German. And so I'm not sure whether that would make a huge amount of sense. And then they said, oh, never mind, just go and meet the people. And I said, fine. And it was a small office. It looked like an interesting place to work. I wasn't in any hurry. Particularly having grown up in Ireland at the time, I wasn't in any hurry to go to London. And then after about 5 years, I had the opportunity to become the manager of that office. So I graduated off a desk effectively into management.
Was this bringing us to 1990, around that time?
Yeah, I think I became the manager of the Zurich office of Goldman Sachs in 1987, 88.
I moved to Switzerland in 91, and I really wanted to be in Europe for the whole 1992 thing on after the fall of the wall and all that. It was quite a heady time as well. A lot of things going on, and it was an interesting place to be.
It was an interesting place to be. The time that I spent in Switzerland, I got to know Europe in a way I never would have gotten to know it if I'd been in London. On the other hand, if I look at them more narrowly, at the time, the action was in London. I mean, Zurich was a backwater and London was sort of exploding in the 1980s. And I was actually quite keen during that time to get out of Zurich and back to London, sort of by the mid-1980s. But in the end, had this opportunity to step up into management in Zurich. So did that instead. Probably a mistake. I was probably, again, in retrospect, probably too young to take on even that responsibility at that time. I did okay and it was interesting. But what was happening in London was much more interesting.
You're totally right. I mean, it's not even comparable. But what was Goldman doing in Zurich at that point with such a small office?
3 things. They did institutional brokerage for large Swiss institutions and also at the time German and Italians because they didn't have an office there when I first went there. They did private client business. It was during my time as manager that we applied for our Swiss banking license, so in the late 1980s. And then they were doing a Swiss franc capital markets type business. It was a very embryonic derivatives market, really a warrants market, which grew up in Switzerland, which Goldman was participating in. So those were the sort of the 3 legs of the business. This was a time when London was exploding.
So eventually you did move to London with Goldman then. And then what were you doing there?
I joined the equity capital markets group in London. I had specific responsibility for what they called alternative investments, which is a well-known term now, but was not very well known at that time. I was working for a guy who was based in New York. We spent a lot of time, frankly, raising capital for Goldman's funds. That was the time when Goldman were getting into the private equity business and they raised their first private equity funds. So I was very involved in that whole process, as well as doing some more traditional equity capital markets type.
After about a total of 15 years with Goldman, you're back in London now. You transitioned to JPMorgan as the global head of research.
There was a couple of steps in between that. I got this opportunity to go to JPMorgan in, I think, 1995, 96. It was at the time I had moved from equity capital markets into asset management, into Goldman Sachs asset management. I realized I was more interested in being back on the sell side. And I had this opportunity through a headhunter to go talk to JPMorgan, who at the time were trying to build an equity business in Europe. They had nothing, in fact, or almost nothing. I felt I'd taken a couple of wrong turns in my career at Goldman Sachs. And this was a chance to go to another really a great firm. And I went in there originally to run the European equity sales business and then became director of European equity research. And then I became head of European equity. So that was my path over the first 4 or 5 years at JPMorgan. And then after I'd run the European equity business for a couple of years, then I became global head of research.
So you went back into sales on the sales side. And then your tenure at Morgan coincided with 2 of the most significant market dislocations in modern history. First had the dot-com bubble around the turn of the century, and then the 2008 financial crisis. How did witnessing these events from inside a major financial institution influence your thinking about capital allocation and market efficiency, or did you not have time to think about it?
Well, I think I was at a very different stage than for the first one that I was for the second one. I mean, I think for the first one, I was at the time running the European equity business. And of course, that sort of meltdown of the dot-com bubble started in the equity business and was driven by the excessive valuations of a lot of these companies. There was a whole thing at the time around research analysts and how they had been used to pump up company stories ahead of IPOs and so on. JPMorgan really didn't have a big equity franchise at the time, so we were just building it up. So we weren't directly, certainly not in Europe, in the middle of it. But the reason that I was moved to be the global head of research was to try to bring some sense to that whole, as you remember, there was the whole Spitzer investigation and there was a whole restructuring of research departments around Wall Street. And so I was moved over to actually execute that restructuring, which was really getting rid of a lot of people, substantially cutting people's compensation. Was a very difficult time. So my role there was much more from an execution perspective rather than a strategic perspective. I think I was in a very different place when the global financial crisis happened because I was more senior at JPMorgan, was on the management committee of the investment bank. We were very privileged or lucky or well managed at JPMorgan in the sense that we were never the firm that was threatened. I mean, we were always the firm that was in this sort of strong position where we were receiving liquidity when other organizations were losing it. And obviously everybody's share prices were going down, but you didn't feel like your institution was about to completely melt down, which was the case for most of my colleagues. We were able to see firsthand the damage that excesses in financial markets could cause. And we were lucky or well managed. Jamie Dimon arrived at JPMorgan in 2005. And I think had about 2.5 years to really straighten out the risk management culture at the firm. And I remember lots of discussions prior to the financial crisis where bankers and others were putting pressure on him to allow for more risk. We were losing market share in a lot of these mortgage-backed securities markets. We were losing market share in the leveraged loan markets. And we were losing it because we weren't willing to take the sort of risks other people were taking. Because I think, to be fair, that Jamie Dimon understood what was going on, saw what the consequences were going to be and positioned us for that. And that has led to the JPMorgan that you have today. What everyone saw, not just people in the industry, saw was just how much damage to real people's lives could be done by this excess of a relatively small number of people within these rather esoteric financial markets. That had a big impact on everybody.
It was like that big ball in the Temple of Doom coming right through downtown Geneva and everything else. Even the Madoff stuff, the tide went out and all kinds of people had no bathing suits on anymore.
Yes.
Then right in the middle of all of this, while everyone else is trying to save their own skin, you started to build something called the Social Sector Finance Unit at JPMorgan. Tell me how that came about. I guess you ended up essentially trying to convince one of the world's biggest investment banks to care about social impact during the worst financial crisis in decades. So that takes incredible vision or incredible naivety. Tell me how that came about and what you were doing.
I think it was a fortuitous confluence of events, really. And from my perspective, I suppose, arguably, I was in the right place at the right time. I think, to be fair, that Jamie Dimon has always had a strong view of the importance of banks and financial institutions sort of in communities and has always felt that their role goes beyond just being a money-making institution and that their responsibilities go more broadly than that. So that's always, I think, been in his sort of DNA. But what specifically happened was there was a managing director of JPMorgan, a lady by the name of Christina Leon-Huvud, who now runs a company called Bluemark. And Christina had taken a year sabbatical, had come back to JPMorgan. Jamie had really wanted her to come back into the firm and had said, look, whatever you want to do when you come back, I'll make it happen. And Christina had this idea that JPMorgan should have a dedicated, what we call the social sector finance group, that would think about how we could use the assets, the capital, the people, the technology that JPMorgan had to develop products and raise capital for things that had more of a community or, I guess, a social benefit. To some extent, it was driven by what we were seeing happening in microfinance, because you remember microfinance preceded that. The microfinance market and banks, including many Swiss banks, were raising money for microfinance institutions from the mid-1990s. And that was the precursor for a lot of the impact investment movement. They saw that it is possible to raise money for institutions that are doing good things and make some sort of a return on that capital. So I think the purpose of the social sector finance group was sort of to extend that idea and use, as I said, JPMorgan's capital, its people, its technology to try and find ways of doing that. So that was Christina's idea. And Jamie bought into that idea and was made available a small amount of capital and a small number of headcount. And then they needed somebody, Jamie and Bill Winters, who then ran the investment bank, they needed somebody to supervise what Christina was doing. And I had shown an interest in microfinance prior to that, partly through some philanthropic work. And then so they asked me, just keep an eye on this. That was my entry into, I suppose, what is now known as impact investment. And as a result of that and the efforts that Christina was making, we got invited to a famous conference in Bellagio in Switzerland that the Rockefeller Foundation organized. There were a couple of meetings, I think, around impact investment at that time. And I was at the second one with Christina. That was my entry into the world of impact investment.
What was the social sector finance unit? Were they advisors, or was it a fund or a family of funds, or what was it?
We felt very strongly at the time that we needed if we were going to be more than just a talking shop, we needed some capital. And so the bank needed to make available some capital so that we could invest in things like impact-oriented funds. So as I recall, they made available something like up to $100 million or something. So it allowed us to build a small portfolio of impact funds. We did bottom of the pyramid fund in Latin America. We were one of the very first investors in Leapfrog. And if you asked Andy Cooper, who were the key investors right at the beginning of Leapfrog, he'll tell you that JPMorgan and the social sector finance is absolutely critical to getting that off the ground. We invested in a Microvest, which is based in Washington. So we tried to find credible impact funds, which at the time was really difficult. And we had a small amount of capital to do that.
Were you attracting capital also to co-invest, or you just had a fund and you were doing it yourself?
I mean, again, if you go to the Leapfrog example, it's probably a reasonably good one. Again, I think Andy would agree that JPMorgan putting money on the table, I think we invested something like $20 million in the first Leapfrog fund, was catalytic in terms of him being able to attract other investors. And so we weren't providing any sort of subsidized capital or blended finance. I don't think there was an expectation that the return on these funds was going to be spectacular. Although frankly, looking back on the portfolio we built up, the returns were somewhat better than some of the other riskier stuff that JPMorgan was doing at the time. The ambition was to make a reasonable return, recycle the capital, and prove the concepts, prove things like Leapfrog is probably a good example, prove that these type of funds, if they were supported by credible names like JPMorgan, that could help them, that they would be able to attract capital from people other than mainstream capital providers.
And then around 2010, you co-authored a report titled Impact Investments and Emerging Asset Class. And in hindsight, it was groundbreaking. When you were writing it, did you have any sense that you were helping to create an entirely new industry, or did it feel like you were just channeling the zeitgeist that was already happening?
That report came about because when Christina and I went to the Bellagio meeting, they sort of went round the table at the end. There were probably 20 people there, and they wanted everybody to say what they could do to help build this, what they were calling an impact investment movement. And so when they got to me, I said, well, I'm the global head of research at JPMorgan. We have 1 million people on our mailing list, which I believe was true at the time, on one sort or another. And so we can write a research report. And there were 1,000 people working in the research department at that time. So I said, I can get a couple of these people and we can write a research report on impact investment and introduce this as a potentially a new asset class. So that was our commitment from Bellagio. And then we went out together with the Rockefeller Foundation. We developed this report explaining what impact investment was, talking about the potential, talking about these sort of issues that could address. You describe it as groundbreaking, but a lot of it we were making up as we went along. We were in an area that nobody had ever explored before. Everybody's very keen that we have a number to show what is the potential of this market. So we came up with this, I think, $1 trillion number, or $2 trillion number everybody thought was completely fanciful. We looked at the various sectors that potentially could be defined as impact sectors. We looked at how much capital they would need to fill the gaps that were obvious, particularly in emerging markets. And then we put this into a report. We were questioned at the time as to why we were even publishing this, because in the mainstream JPMorgan, obviously, there was no interest in this. And it felt like a bit of a vanity project, I suppose, to a lot of people. But in fact, I believe that it was one of the most widely read pieces of research JPMorgan ever published. Now, partly that was because the shelf life was much longer than most of what the sell-side research department publishes. But it did attract a lot of attention because I think it did, as you say, capture a bit the zeitgeist. The idea people had been questioning, this was 2010 when we published, had looked at the damage caused by the financial crisis in 2008. And they were looking for ways in which the financial markets could be harnessed to do something more positive, outcomes and impact. Other people had been talking about impact investment before that. But I think what was different about that, we were a big name in a sense, and we had a lot of credibility. And so us putting our name on a report on impact investment was much more influential, I think, than we would have expected at the time. The surprising thing for me was we didn't get a lot of scrutiny. We spent a lot of time trying to work these numbers just to figure out how big this market could be. Very little scrutiny of those numbers. Well, if JPMorgan are saying it, there must be some validity to it. But the fact that we have put our name to it, definitely, it wasn't the only thing that drove impact investment, but it was certainly had a catalytic effect at the time.
I remember very much that period of time. I would say that people were definitely in the mood to reevaluate and were open and in a way searching to say there must be a better way, so to speak.
Yes. There was a certain naivety to that.
I remember quite well.
There was an appetite for a different approach.
Right. So at this early stage, how were you defining impact? Because this is a new thing, right? How were you defining that, and what was this very early theory of change at that point in time when you formed this unit and this was starting to get some currency?
The biggest challenge, and still to this day, to a large extent, the biggest challenge has always been with impact investment is how do you measure the impact side of what you're trying to do? And so if you go back to that time, so 2010, obviously, that was very early in the development of impact measurements. And I look at some of the methodologies that have been developed over the last decade or so. I mean, we were really in the very early days of trying to measure and understand what impact financial decisions and investment decisions had. I mean, we had this high level view that if we should be channeling more of our investments to assets that were going to have a materially beneficial impact on people's lives. I mean, that to some extent, that led you to a lot of sort of bottom of the pyramid type of investing where you were looking to develop affordable and accessible goods and services for lower income groups. Microfinance is an example of that. Some of the housing projects, lower income housing projects that were funded, particularly in the United States in the early days of impact investment, were an example of that. There wasn't a science to it. I mean, certainly you may recall differently, but it felt like it was very sort of embryonic and it was impact if you see it rather than anything, as I say, particularly scientific.
I don't remember it any different. I remember people grasping everyone. The whole concept seemed to be something everyone agreed on, but you get 10 people in a room discussing it, you're probably going to get 11 different answers about what that means. So somewhere around 2011, you meet Sir Ronald Cohen, who was a friend of the podcast, and he's been on a few months ago. You both decide to co-found what eventually becomes Better Society Capital. And apparently you start this company in his basement. So the very first thing I want to know is, what does Sir Ronald's basement look like and what's down there?
I mean, at the time, he had this office in Portland Place in London, which is a very nice office. But in the basement, there was a basement with a room in it with like white walls and nothing else. I left JPMorgan to work with Ronnie to do this effectively startup. So yeah, I mean, the first day I was there, and obviously we weren't being paid or anything. We were just trying to get this thing up and running. But yeah, there was nothing. I remember trying to see if I could get a printer to work in the basement. From that perspective, it was a startup. From another perspective, it was easier, I suppose, because Ronnie had done a huge amount of work ahead of that with originally the Labour government, Gordon Brown, Tony Blair, and then post-2010 with the coalition government, and had been involved in the dormant assets legislation, which created the pool of dormant assets, which was then used to fund Big Society Capital. And also Ronnie was a person who had convinced the government that the best use of these funds was to create a social investment wholesaler. It was the Cameron government's idea. Well, obviously the Big Society's sort of name was a political brand they were using. It was their idea also to persuade, arm twist is probably a better word, the big four UK banks to put money into it. So we were able to capitalize this thing with the commitment of dormant assets and then this £200 million or so from these four big UK banks. It was at the time a unique organization. It's been copied in a number of places around the world, has made, I think, a significant contribution over the last decade or more to the social sector in the UK, both by investing directly and just more importantly by, I think, leveraging in other forms of capital. It started in a basement with nothing except white walls.
So what was the core thesis behind Better Society Capital? What was the market failure opportunity gap that you guys were articulating, that you were attempting to address, that existing institutions weren't solving?
Underlying thesis was that the social sector historically had relied only on grants and the largesse of government, and that there was at least some social issues that could be addressed through capital and through investment. But at the moment, there was no way of channeling. There was no intermediary layer that was channeling capital into those social sector organizations. And so the idea was to set up a social investment wholesaler that would channel money into intermediaries, private loan or equity funds that were specifically trying to lend money or invest money into social sector organizations. So that was the idea. And obviously we were working without any blueprint, which was in many respects, I think, exciting. And when I look back on how we structured the organization, it has survived and I think prospered over the last 12 or 13 years. But I think we spent a lot of time thinking about how we were going to set up the governance to secure the mission of the organization. We spent a lot of time thinking about eligibility and was it just nonprofits that we were going to be making money available to, or was it going to be broader than that, and sort of self-described impact investors. And if it was impact investors, how we were going to define an impact investor. So those were the choices that we made. And you'll remember at the time, impact investment was very nascent. There was very little you could invest in, actually. And it was something that post the financial crisis, as we discussed, was getting a lot of hype, frankly. But there was a lot more hype than there was money moving. And so this was an attempt to take a pool of money and try to use it to sort of seed and catalyze all these different intermediate organizations so they could pass the money down into the social sector organizations and impact investments.
So you became the first chief executive of Better Society Capital. Admittedly, the digs weren't glamorous at the beginning in Ronald's basement. But what changed in the UK's approach to social investing of what you built there?
It was more what was shown to be possible, I suppose. Prior to BSC being created, there was no capital. The banks were very reluctant to lend to anything other than traditional corporate forms. What BSC was able to do was demonstrate that there was a market, there was a demand from social sector organizations, and that it wasn't something, you couldn't address every social problem through investment, but you could address some of them. I think it's led to a much greater acceptance within certainly the UK of this idea that the value of investment in addition to grants and recognition, as I said, it's not the answer to everything, but it can in certain circumstances make a difference. You're lending to people and lending in places and lending organizations that just would not be able to access traditional models, traditional financial institutions.
I think we won't go more into it today, but it's a huge organization now. It's mobilizing a lot of capital. And I encourage any listener to go back and listen to that episode where Stephen does a deep dive into what they're doing today. But it all started with you. That's amazing. You did that for about 5 years, and then you leave BSC to become a senior advisor at the Bill and Melinda Gates Foundation. So that's moving from investment capital that needs to generate returns to philanthropic capital that doesn't, or performance philanthropy, perhaps. So tell me what led to you leaving BSC and how did this opportunity come about? I think you were an advisor. I don't think it was a full-time gig for you. And what was the transition like for you mentally and practically going from a return-driven endeavor to philanthropy?
When I left BSC, I'd been the chief executive there for I think 5 years. And then we probably had an additional year of sort of setup. That was always what my commitment was post JPMorgan. I wasn't looking for a job that I was going to do for 20 years. And I also felt, I think, that I'd taken BSC probably as far as I could take it. And it needed somebody to go to the next stage. It needed somebody more like sort of Cliff originally, and then more like Stephen. And so I felt it was the right time for me to leave. Ronnie had stepped down as chairman after about 3 years or so. And Harvey McGrath was then the chairman for, I think, at least another 7 or 8 years. So it felt like a good time to transition. At the time, I was looking to get out of working 5-day weeks. I mean, I thought I would do something a bit more plural. BSC obviously was very UK focused. In fact, by exclusively UK focused. And in the early days of when we were developing the impact investment theme in JPMorgan. I'd always been interested in development and emerging markets. When I announced I was stepping down from BSC, I knew people, obviously, the Gates Foundation. So they encouraged me to think about coming in and helping them. At the time, they were beginning to look at the idea of blended finance. And they were beginning to ask the question of, look, we've got all this philanthropic capital and we're giving away whatever it was, $7 billion a year, whatever it was. We're giving it away all in grants. And there were certain people within the organization, not everybody, but certain people who felt that they should try to explore this idea of using philanthropic capital to catalyze other forms of more commercial or impact capital. And so they wanted somebody who had some experience in that field to help advise them. And so I joined them, and really as a senior advisor. And actually I was working 3 days a week for them. So it was quite a substantial commitment at the time.
Now, at this point, you worked across the entire spectrum, right? From pure profit-driven iBanking to the early days of impact investing to pure philanthropy. What did you learn about the unique role each type of capital can play? And when does philanthropy work best? And when do you need the discipline of market returns?
There aren't a huge number of people who've had the opportunity to work in red-blooded commercial organizations like JPMorgan or Goldman Sachs, to work in government-owned, effectively government. So although we had a degree of independence, both at BSC and BII, and also in what is the world's largest philanthropic organization. So I've had that opportunity to do all those things. And it does give you a very interesting perspective. I think when you come into this sort of philanthropic world, the first thing you realize is just how difficult what they do is. I mean, I think there's a naive sense, particularly in the commercial world, that it must be really easy giving away money. You don't have to worry about getting it back. So how difficult can that be? And in fact, of course, it's extraordinarily difficult, particularly if you're trying to do it in any sort of scale, which obviously the foundations, the Gates Foundation, other large foundations are. You acquire a much greater level of respect for organizations that do that well. And just like in the commercial world, there were organizations that do it well and organizations that don't do it well. And I think the Gates Foundation clearly has been, over the years, has been extremely successful in staying focused on its core issues and programs. That reflects the personality of the founder, and it lies at the heart of its success. I mean, that's what I remember being most struck by, this idea that this is really difficult to do this well, and the challenge of how you measure whether you're doing it well or not, what the success metrics really are. I think you build up a much greater level of respect for people in that field.
Then 18 months later, you get the call to become chief executive of British International Investment. What was it about that opportunity that made you want to take on leading the UK's largest development finance institution?
Yeah, so I think that was, in looking back, a very easy decision to apply for that role, because I felt like being an advisor was not really what I was particularly good at. All organizations are political in their own way. And I just didn't feel, if you're an advisor and you feel you have to force yourself into the discussion, that's a difficult role to play. I really enjoyed my time at the Gates Foundation. And having said that, I was trying to get out of a 5-day-a-week full-time job. There were very few jobs that I would have gone after, but that was definitely one of them. What was then CDC was definitely one of them. Because to me, it felt like it was pulling together all the things that I'd been doing over really the last 20 or 30 years in terms of leveraging my investment experience, my large institutional experience, and of course, impact investment experience. And so it was a very easy decision. You never think you're going to get those jobs because they come with, if you read the sort of specs for what the new CEO of what was then CDC should have, then there's a whole lot of different things. And nobody has all of those things. So you focus on, well, they need somebody who really knows Africa. And I've been there as a tourist and done a bit of work in South Africa. So you don't ever think you'll get them. You'll get the job. But I was lucky enough to get it. And I think within the UK, CDC then, BII, it was a unique organization. I mean, we are the UK's development finance institution. It was a time when DFID, as was providing a lot of extra capital and had the commitment to continue to do that. My predecessor, Diana Noble, had successfully transformed it from just being a fund of funds into an organization that was now doing a lot more than just fund investing, but investing directly in equity and debt. And so she'd really moved the needle. But there was clearly a lot of potential growth there and a lot of support from the government. So it was a fantastic board, great chairman, Graham Wrigley. That was an easy decision to apply for the job. And I was very pleased to have the opportunity to do it.
For people listening who aren't familiar with BII, can you just give a high-level overview? And what's its mission and what it's doing?
Every sort of major donor country has their own DFI, their own bilateral DFIs. What the DFI does is it's sort of the investment arm of the country's development program. So in the UK, we have obviously, although it shrunk substantially over the last 3 or 4 years, but historically the UK has been a very significant development budget where we've been giving money to emerging economies to help them grow, to help improve, to address humanitarian crises, but also to help these economies grow and help improve the lives of the people who live in these countries. And so most of that development budget is done through grant making, but some part of every country's development support now is done through investment. And the idea is that the African continent is an example, sub-Saharan Africa. These countries are desperately short of capital. Without capital, companies can't grow. If you don't have companies that grow, then you can't create jobs. If you don't create jobs, then nobody pays taxes. And so you can't create social and public services. So it sort of becomes a vicious circle. No country has successfully emerged from poverty without a thriving private sector. So the role of the DFI is really to provide the capital, to help the private sector to grow. And it focuses very much on areas which are fundamental to development. So infrastructure, for example, was a big investment theme at BII, and we would support areas like power infrastructure, now increasingly or almost exclusively renewable energy power, things like digital infrastructure, transport infrastructure. So that's an example of a theme. We'd support manufacturing businesses to help them grow and build new factories so that they can employ more people. It's providing capital in places and to companies that wouldn't necessarily have it. And the remit of a DFI is to make a return. So we're not in the business of giving money away. Typically have very small grant making we're called technical assistance budgets, but really we're investment institutions that are expected to invest in these countries, in companies, private companies, debt and equity, and over time get that money back, earn some sort of a return, and then recycle the money over and over again. And BII, or CDC, as it was known before, was the world's first development finance institution. And we were founded in 1948. So it was the UK that sort of created the idea of DFIs. And then in addition to bilateral DFIs, we obviously have the multilateral development banks are also doing some of the same things as DFIs do. The IFC obviously is exclusively focused on private sector investment. It's an arm of the World Bank. But then within the African Development Bank or the Asian Development Bank, you have their private sector units that are all investing in the private sector.
When you say you invest patient, flexible capital, that's a phrase that gets thrown around a lot in our industry. What does it actually mean?
Patient means really long term. You don't have to get the money back. One of the unique characteristics of BII is its focus on equity. The equity that's provided and basically private equity rather than investing in sort of stock markets. We know that private equity firms have these 5-year investment cycles, 10-year lives. Almost as soon as they're invested, they're looking to see how they're going to exit. Development finance institutions are different. I mean, we don't have that requirement to exit. We don't have to raise a new fund. And obviously, you want to have a sense that at some point you can get out of an investment, but certainly BII is happy doing things. They might not see an exit for 10, 15 years. So that's what we mean by patient, not in a hurry to exit. And from a debt perspective, we'll make loans with maturities and tenors that are long. Traditionally, particularly in the markets when we're investing, it's very difficult to get a debt that's going out for companies to raise debt longer than about 5 years. Whereas DFIs, and again, in some sectors like infrastructure, you really do need 10, 15, 20-year debt. And DFIs will provide that. So that's what we mean by patient. By flexible, we mean, by definition, banks need to have sort of a cookie cutter approach to lending. Things need to be standardized, and that's standardized in terms, repayment term, what type of security they get, that type of thing. DFIs are much more willing to engage on a much more bespoke basis and adjust the terms of the investment, whether that's the tenor or repayment holidays or security conditions, adjust it to make it work for the borrower.
BII is owned fully by the UK government, but you're not on the gravy train. You have to get a return. I think you targeted a modest 2% return. And I guess the calculation is with that 2% return, you do have a mandate to be self-sustainable. And with that 2% return, you can self-sustain. How do you reconcile this with critics who argue that if impact investments cannot generate market rate returns, they will fail to attract the scale of private capital that we need to address global challenges.
Yeah, I think that's a sort of a false dichotomy in a sense. It's certainly the case that if you want to attract commercial capital at scale, commercial investors have a fiduciary responsibility to maximize the risk-adjusted return of their investments for their beneficiaries. So for many institutions, to many commercial investors, they're going to have to at least believe that they can get commercial returns. As we know, even for the most commercial investors, they rarely produce the sort of returns that they promise when you're investing in the fund. If you're going to attract commercial capital at scale, you're going to have to offer those returns, and you can either offer them by restricting the investments you make to those things that are most attractive commercially, or potentially you could offer them by providing some form of blended interest in the capital structure. I think it's less about return and more about risk. I mean, if you want to really create the maximum impact, take Africa, for example, which is an area that BII does a lot, about 60% of its portfolio is invested in Africa. If you want to invest in sub-Saharan Africa, these are really difficult, risky countries. They have pretty much every African country went through, in my 7 years running BII, went through some sort of major macroeconomic or political turmoil that led almost inevitably to a significant devaluation of its currency, for example. So if you're invested in equity, you're invested in local currency, it makes it very difficult to make money. So I think that if you're going to take those levels of risk across a portfolio, and you're not able to price for those risks appropriately, which I think is just the reality of investing in Africa, then over a portfolio, you're going to end up with a return that looks unattractive to the most commercial investors. And that doesn't mean that on an individual investment basis, you're not seeking to earn certainly a return, and in many cases trying to earn a commercial return. But if you're consistently taking higher levels of risk, and you're really not able to fully price for that, over time, you will end up across a portfolio with a return that is suboptimal.
You targeted 2% return, but you left BII last year, I believe. You put a farewell post on LinkedIn, and in that post, you wrote that you actually achieved 5%. So how did that happen?
The 2% target came from government. The whole underlying concept of a development finance institution is it should be sustainable. And in order to be sustainable, you have to have a return in your capital. That was a precondition. I suppose if you're running the investment portfolio, you're making a whole series of different investment decisions. Each one of them, you don't sort of sit down and precisely try to calculate how you make 2%. In some of the investments we were making, we created a company called MedAccess, for example, which does volume guarantees for pharmaceutical products for developing countries. It guarantees for manufacturers that there will be demand for these products at given prices. There's no way that company can make even 2% given the way it's structured. So you'll do those sort of investments. And then on the other hand, you had an Indian venture capital portfolio, which was probably pretty close to commercial. India was the one country during my tenure which didn't have a major financial or economic crisis. So our returns in some of the things that we did in India were very attractive. So we had investments in solar, we had investments in hospitals, for example, that produced very high returns. Obviously, a third of what we did was debt. So you're obviously hoping that the money gets repaid. You've got a certain return on that. So you're just looking across a whole portfolio. And if things go slightly better than you hope, then you end up with, we ended up with a 5% return. And we were able to do that in an environment where a lot went wrong, particularly, as I said, in Africa. We had a lot of very different investments there. But between being careful about our credit risk we were taking, having some good fortune in some of our investments, particularly in Asia, we were able to earn that return.
Walk me through BII's investment approach at a high level. You focus on high risk emerging markets, as you said, particularly in Africa and lower middle income countries. You operate two portfolios, Catalyst and Growth. And during your tenure, you developed something called the impact score methodology. How did you balance achieving genuine impact with the need to hit that 2% target return or some return in order to remain self-sustaining?
Yeah, so you're right. I mean, BII, obviously its investment approach starts with certain eligible geographies, which for most of my time there were Africa and South Asia. Now they've extended to do more in Southeast Asia. We had certain sectors that we emphasized. They included infrastructure, financial services, manufacturing, agriculture. Those were sectors that we felt were particularly core and key to development. So we would seek to find opportunities in those areas. Just before I got there, they had the DFID, the UK government, who's the shareholder, I think felt that they wanted to incentivize the organization to take even more risks than it was taking. And so they created what was called this Catalyst portfolio. The Catalyst portfolio was a portfolio where the expected return was anticipated to be less than zero. The idea was you were going to be willing to take so much risk, and there was risk in terms of countries, in terms of technologies, in terms of people, and to the businesses, that you were likely to end up with a negative return. In fact, the Catalyst return is more or less, our Catalyst portfolio is more or less broken even. So we get a lot of investment officers who find opportunities to make investments, and realistically, an investment committee just can't get comfortable that they'll ever get there, that they really, that the likelihood of getting the money back is strong enough that they're willing to take the risk. The Catalyst portfolio was put there to allow them to have a pool of money that they could use for those type of higher risk investments.
Is the idea that you make an investment, but then it's kind of blended and maybe you take first loss and then you bring in private, or you just investing and expecting you're going to lose the whole damn thing, or what?
A couple of different things. It was doing some very high risk investing. When I got there, I did 3 or 4 investments in Malawi, for example. They were small, they were startups, and that sort of thing is really, even for an organization like BII, is beyond the risk tolerance. So we needed to have a separate portfolio to do that in. But it's also, over the last 7 years, become increasingly used for blended finance, where it's used to be junior tranche, and whether it's in a fund or a debt instrument, or sometimes in equity, it's the higher risk tranche that's effectively mitigating the risk for the more senior investors.
I had Yasemin Salatu-Klami on the show a little while back, and we spoke a bit then about the impact score methodology. And I think that was a tool that was created under your direction. Briefly tell me about this tool and what was the goal behind creating the tool. And in the end, what tangible impact did that end up having on BII's investment strategy?
Well, I think it goes back to one of the questions you asked earlier, which is about how do you measure your impact? There's a certain amount of science involved in sort of figuring out or forecasting what your expected return will be. How you decide what your impact will be or is likely to be is much more problematic. And I think what we found was, when I first arrived there, that BII didn't really have any framework. So we'd come to investment committees. Obviously, investment teams are really anxious to get their transactions funded by the time they've done all the work that's required to take it to an investment committee. And the investment committee members, who at BII are largely external, or many of them are external, are obviously tend to be somewhat skeptical of some of the claims that were made around impact. We had this quite long debate about, do we need a scoring system or not? And there are disadvantages to the scoring system, because by definition, they're always going to be somewhat subjective. And therefore, people tend to be skeptical of them as a result. But we decided, and I've been there probably a couple of years at this stage, that we absolutely had to provide some sort of a rigorous framework that we could use that would have to embody a scoring system. That would also give us the ability over time to track history and look at the correlations between impact and return, for example. So we spent best part of a couple of years developing what we call the PSI system, recognizing that what we were really trying to do with our investments was to make investments that were inclusive, meaning they led to more inclusive societies in the countries that we were investing in, that they were sustainable, meaning that they were supporting climate transition in these countries, and that they were productive, meaning they were helping to provide more accessible, more affordable goods and services that were helping to create jobs and help grow economies. So we developed a methodology which measured each investment, assigned a score for each investment along each of those 3 verticals. And that became the PSI score. And we had certain other organizations have developed scoring systems. Some don't have any scoring systems, and then they have the challenges of not having a framework. Some have these really complicated scoring systems, which take dozens and dozens of people to do. And the investment teams, the people in the field actually trying to originate transactions, have no idea what the score is likely to be. So we wanted to find something in the middle where it was a simple enough system that everybody, investment officers, could pretty much know when they met a company where it might come out on the PSI, but rigorous enough that it really gave investment committees real guidance as to where this stacked up. It was quite a controversial process, because obviously investment teams don't like to have their investment universes restricted in any way. They'll want as much flexibility as possible. And then on the other hand, the people that are more responsible for impact want to really be very focused on making sure that our money, which is obvious, capital is always scarce, that our money is going to do most impactful things. And also importantly, from a development finance perspective, things that are most additional. The UK taxpayer doesn't fund BII to do the things that banks would do anyway. So it's that concept of additionality is also important.
In the end, was it generally recognized that this was a very good representation of impact as opposed to black boxes or whatever can become a system that can be gamed?
I think it had a profound impact on the organization. And I think generally speaking, there's a very wide level of buy-in and acceptance. It was to a large extent, we had this very unpredictable investment process where investment teams would spend all this time developing transactions and they would have no idea where the investment committee members were going to come out, particularly on this impact question. So it gave them this rigor. It gave a rigorous system, saved everybody a lot of time. And I think that they also, there was quite a bit of to and fro, but the PSI system is sufficiently flexible that BII has still been able to invest $2.5 billion. So we can still find investments. What it does is it cuts off the tail of those things that maybe we could push them over the line, but we really got to have a story for them.
And you've mentioned how BII's portfolio is more concentrated in equity than almost any other large DFI I can think of. And I think you have about 3/4, 75% in equity and 25% in debt. That's taking on significant risk. How did you migrate to that allocation?
Well, historically, it was something I guess I inherited. CDC before it has always been an equity-oriented firm. I think that started probably with the idea that was the scarcest form of capital. There are, let's be honest, all these countries, even the most challenged countries, have banking systems. And those banking systems, they don't provide, as we say, very patient or very flexible debt lending, but they do definitely do some. Whereas equity in many countries is almost impossible to obtain. So that was always from, if you go back even the 80s and 90s, that was true at BII. I think we're also able to do that because we have a capital structure. Our own capital structure is 100% equity funded. Many of the other, particularly the European development finance institutions, look more like banks. They have leveraged capital structures, so they have to borrow money in the market to fund their balance sheet. And if you have to do that, then you have to worry about things like credit ratings. You have to be much more focused on risk and volatility because you're often, in some cases like the Dutch, they're actually regulated by the banking regulator. So this puts all sorts of supervisory pressure on them. It's very hard for those type of institutions to have their own assets heavily weighted towards equity. BII, because it's 100% equity funded, we're more like a fund or an investment company. And so we have no debt on our own balance sheet. So that means you can assume more volatility. If you have a year where your portfolio is up 10%, that's good. If you have a year where it's down, as we did, the 5%, I think was the worst year we had. That's not a huge issue. It would be a much bigger issue if you had lenders who were focused on that.
Not long after you started at BII, you made one of your first trips to the remote interior of the Democratic Republic of Congo. Can you paint that picture for me and explain what that trip taught you about both the challenges and the impact opportunities of investing in some of the world's most remote regions?
That was probably about 2 months after I joined BII. And of course, one of the things I didn't bring to BII necessarily was huge experience in Africa. And obviously, one of the things you want to do as an incoming chief executive of an investment organization like what was then CDC is to try to get out there and visit on the ground, kick the tires, visit the actual investments, see the companies. And so people at the organization told me, well, Nick, if you really want to show that you're tough enough to do this job, the investment you need to go to see is this investment known as Ronia. It was a palm oil plantation. It was right in the middle of the DRC. In order to get there, you have to fly to a city called Kisangani, which is about probably 3 hours flight itself from Kinshasa, so right in the middle of the country. And then you have to get on a little motorboat and go down the Congo River for 6 hours to reach this place. And then you can see the impact that our money and our investment in this company is making. And so I said, okay, I'm good for that. I made the trip actually with the head of the German DFI was also with me. And it was just quite extraordinary. It's the most remote part of the world I've ever been in. If you're going down the Congo River today, it hasn't really changed since Stanley went down the Congo River for the first time in the late 19th century. You see no signs of any sort of formal economic activity. You see various settlements along the river. You see people out in these wooden canoes fishing and the subsistence fishing. You realize how remote it is, how far you are from any sort of formal employment or any sort of real economy. Then you get to this, and this is a plantation CDC, I think, had acquired probably 2 or 3 years before I got there. It was actually originally founded by Unilever 100 years ago, 150, more than 100 years ago. It really is in the middle of nowhere, but it's absolutely critical to supporting the livelihoods. In theory, the 10,000 people that live there, that work there, and their immediate families. But then what tends to happen in a place like that, when you create something that is paying wages and creating some sort of formal job structure, you get people just move there. So without really intending to, you end up with a sort of a town of I think it was 80 or 90,000 people who are all one way or another dependent on the work that comes from the plantations. Nobody else would have made those investments because the chances of actually having a successful investment were so small, to be honest. It did make me think, give me a real sense of just how beneficial investment of that type could be, because without CDC coming in, this enterprise would have gone bankrupt. All those jobs would have been lost. Those people would have been dispersed to really the most basic form of subsistence farming. So from that perspective, it was everything you wanted DFI's investment to be. It was additional, and the money that we were investing was paying for them to build new mills so that they could increase productivity and so on. So that was all the good stuff. The challenges, though, are in a place like the DRC. I mean, instituting good governance, ensuring that something that is so remote is not subject to all sorts of corrupt practices is almost impossible. And obviously you, to some extent, you're at the mercy of it's palm oil is a commodity. Effectively, its price goes up and down. So I think over the period of time that BII, CDC owned that investment, they were generally on the wrong end of the palm oil price. But still, I mean, it was always going to be really difficult to try and make a sustainable enterprise there. And in the end, we invested a substantial amount of money. The money was lost because we ended up selling the company, or effectively giving the company away. But on the other hand, today, a company still exists. The jobs are still there. It's owned now by local ownership, which is, I think it's very difficult. It's probably easier for local owners than it is for organizations like BII. Without BII's investment, it would have definitely gone. From an impact perspective, I think you have to say that has been a good investment. But from a financial perspective, obviously not at all.
One of BII's key roles is bringing other investors along for the ride, what you refer to as crowding in private capital. How do you convince a pension fund or an insurance company to invest in the Democratic Republic of Congo alongside of you? What's that conversation like?
When we talk about mobilization of commercial capital, we have to be realistic. There are certain things that commercial capital is not going to do. There are certain things that, frankly, I wouldn't want my pension fund invested in. It's just not consistent with the fiduciary mandate that they're given. So I think when we talk about mobilizing, and this is the challenge with this whole concept of private capital mobilization, we can do a much better job of mobilizing capital into middle-income countries, into larger projects, into lower risk projects, particularly in the climate area where there's a real appetite among institutions for investment. That significantly moved the needle there. And in theory, that would free up more capital for the DFIs to do what they historically have been charged with, which is investing in the lower income countries in the riskier investments. But there is a point beyond which commercial capital will not go, and there's no amount of subsidy or blended finance that's going to encourage them to do it. So there's a spectrum, and we can move commercial capital further along the spectrum by being innovative and creative about the way we help mitigate their risk. But we can't pretend that we'll get them all the way to the supporting these, just something in the middle of the DRC.
You've said something that's provocative in this industry, and you recently argued in EFT that impact investing shouldn't demand high returns and that concessional returns should be the norm. Most people in this space, and most people who have been on this show, say that you can have your cake and eat it too, that you don't have to sacrifice financial returns in order to have great impact. And a lot of people will argue that by not investing sustainably and not incorporating things like ESG and quantifying impact, it will ultimately unfavorably affect your returns in the long run. You're saying that's not true. Why?
It was an interview. I think it was slightly misrepresented what I said. I don't believe that impact investment is about only concessionary returns. But I do think that we have to be realistic about if everybody demands commercial returns, and this is particularly true if you look at some of the developing countries, maybe less true in the developed countries, we may be able to address certain development challenges, but we're certainly not going to address all of them. So there is a need within this sort of impact investment spectrum for investors seeking to be more catalytic. And that was, we talked earlier about the Catalyst portfolio. That was part of the reason for developing the Catalyst portfolio. Certain of the larger foundations have these catalytic capital portfolios. So if you really want to do the really hardest things, then you have to provide some concessionality. That doesn't mean to say there isn't a huge opportunity for organizations who want to be impact investors and who feel quite justifiably that they are required to earn fiduciary or risk-adjusted market returns, that there isn't a huge opportunity for them. But you do need both. And also by definition, I suppose, blended capital is blending concessionary capital with more commercial capital. So if you're ever going to have any blended capital, it has to come from pools of money, from catalytic capital. But I completely understand the fiduciary responsibilities of many organizations preclude them from doing some of the most impactful things.
You did not argue that it should be the norm. You're arguing that there's a place for it.
That's exactly right. I don't think I said it should be the norm. I suppose I do think sometimes some of the impact investment opportunities have been over promoted as being a free lunch. I'm not saying it's not possible, but it's not easy.
Nick, I'm absolutely shocked that there's over-promotion going on in the financial industry. Absolutely shocked. I recall Michelle Giddens, I spoke with her a few months back, and she published something called The Spectrum of Capital. So you're saying there's time and a place for that. We have to have all of these. And I guess I have to say, talking to as many people as I do, there's a lot of investors who come on and they're adamant you don't have to sacrifice anything, and they won't. Maybe like TPG Rise Fund, they won't. They've got to hit their numbers.
But you ask TPG Rise, how many investments have you made in Africa? I mean, seriously, and the answer is, you ask some of the others specifically preclude investing from Africa. I don't know how you can pretend to be a global impact investment fund and then say, I'm precluding in any investment in the continent that has the greatest distance to travel in terms of reaching the SDGs. And I'm not saying that to be critical of TPG. I think they've tried, but they find it pretty much impossible to find investments that meet their return criteria in Africa. So your choice is, you say, okay, well then impact capital has no role to play. We're not going to make capital available. Or you say, okay, somebody has to be making it available on a somewhat more flexible basis. And I mean, that is, to be fair, the role of the DFI. TPG is running people's pension funds. If my pension fund was being run by TPG, that's what I'd want them to frankly do within the context of the sort of impact criteria that they put around their investment. The reality is, if we're going to provide capital in many of these places, we're going to have to be somewhat concessionaire. That is the role of DFI, and that's what we do.
Speaking of the DFIs now, the development finance landscape has evolved significantly since you departed from BII. Development finance institutions are being asked to play larger roles in the climate transition financing. Can you describe the big changes that you've observed and explain why DFIs, in fact, have become more strategically important?
A couple of things have happened. I think if you look over the last 5-7 years, DFIs have become much more involved in supporting and funding the climate transition in emerging economies. And that's very logical because government shareholders have made, through their various commitments, they've made very substantial financial commitments to funding transition in these economies. A lot of that's going to be done through investment, most of it. When they look around for what investment institutions do we have that we control, that know these markets, that can deploy this level of capital, they alight on the DFI. So what we found with all the development finance institutions is an increasing mandate from governments to support climate finance, and that's very logical. I think there's a question over whether or not does it distract some of these organizations from their more traditional mandate, which is development in lower income countries, because climate finance by definition is going to focus you more on middle income countries, bigger deals, easier deals, closer to commercial transactions. But that shouldn't stop get in the way of DFIs expanding their climate investing activities. But then since I left BII, obviously at the end of last year, there's been substantial changes in the whole development framework. I mean, starting with the sort of evisceration of USAID, the substantial cuts in the development spending by the UK and also by other countries in Europe. That I think is a permanent secular change. We're not going to reverse that in a year or two and go back. The development world has changed forever. There's going to be less money available, particularly for grant making. I think even if you look in the United States and you look at the rhetoric around the USDFC, for example, the indications are that the current US administration wants it to be a bigger organization, not a smaller organization. But I think the challenge is going to be what it's going to be focused on. I don't think you're going to see enormous cutbacks necessarily in development finance, but I think there may be shifting definitions as to what constitutes development finance. For most of the European DFIs, they've had substantial growth over the last 10 or 15 years. I'd expect that growth to be slower. I mean, certainly at BII, we scaled up to a point where we could invest $2 to $2.5 billion. It's going to be difficult for them to continue that level of investment without accessing new capital, which they have been able to do for most of the last 10 years, but are unlikely to be able to do going forward. And that has implications. But, I think overall, development investment is going to become a bigger part of the development pie. That pie is going to be smaller overall, but the investment piece is going to be bigger. And if you talk to many countries that are the recipients of development spending, particularly in Africa, they'll tell you job creation is what we need most. Investment, in order to do that, we need capital. We need private companies who can grow. So investment spending is what they're looking, or they say they're looking for most of all.
Isn't there, though, a structural tension between poverty alleviation in low-income countries and climate finance, which seems to often flow to the middle income nations that have better investment climates? So how should the development community navigate the resource allocation challenge associated with that?
That's a great question. I'm being offered a senior fellowship at Harvard at the Kennedy School. And the research that I'd like to look at that particular question in more detail, because I think it is how are development finance institutions integrating climate finance into their overall portfolios, and to what extent that requirement to do climate investing distracting them and to, I suppose, cannibalizing their more traditional mandate. I think that's a very important question. I've seen firsthand in my last couple of years at BII, there's no doubt if you increase the requirement to do more climate, it pushes you to middle income countries. It pushes you to larger transactions. It pushes you to easier transactions. It pushes you towards things that are closer to market. I mean, that's just closer to commercial. That's just the reality. And as I said, it's not that we shouldn't be using our DFIs and our multilateral development banks to address the climate transition. We absolutely should. They're the organizations, investment organizations, governments, certainly investment organizations, best positioned to do that. But it's how we make sure we get the right balance. And certain countries have already done this quite effectively, like the Norwegians and the Dutch are very clear about this is the piece of our development finance that's going for climate transition that has different impact criteria. And this is the piece that's going for poverty alleviation. But I think every country needs to be that specific. And I think in the UK, we probably haven't been. And if you aren't, you are running the risk of having some cannibalization, I think.
The UN estimates something like $1.2 trillion annual financing gap just for Africa alone for achieving these sustainable development goals. And then, of course, climate transition requires massive investment. So is there even sufficient capital to address both of these challenges simultaneously? Or do we have to decide we're going to go after one or the other?
We've got two huge issues that development finance and impact investment, I suppose, is being asked to address. One is climate transition in emerging markets. And it's critical that we continue to support the transition. It's frankly, when we talk about transition, it's a much bigger issue in Asia than it is in Africa, because in Africa, we don't really have those economies. The challenge in Africa is access to power. It's not transitioning to renewable power. We have to address both of these issues. But I do think it's also important that, particularly when it comes to the development side of this equation, there's no silver bullet, no one thing that's going to suddenly make Africa investable for private capital. I mean, a lot of it is going to have to come from the countries themselves. They're going to have to make sure that they run sensible fiscal policy, that they manage their inflation rates, that they manage their interest rates, that they protect their currencies. Because these are the things that investors are always going to look at and say, well, that level of macroeconomic and to some extent political instability is just inconsistent with the fiduciary responsibilities I have as an investor. So I'm not going to go there. And we need more somehow role models of success. And we've seen a couple develop of economies that can support greater investment.
There's all these people that are always talking about that there's these pools and pools of capital waiting to be allocated. But it seems that the competition to get a capital allocation just keeps getting stiffer and stiffer. And sometimes it feels nearly impossible to get it into high risk places. That makes me wonder, how do we get there? And if everyone can't win, where should the priority be?
When we talk about government supported, funded development spending, investment spending, we've got to make sure we're targeting that in the places that most need it. And that gets you into this question of additionality. And that's why I worry about the climate question, because I think that putting more pressure on development finance institutions to address climate transition pushes them to do things, and particularly when the success metric is basically around capital deployed, right? It pushes them to go to those places which are frankly lower risk, where the capital deployment possibilities are bigger, and to places where very often, and I'm thinking of countries here in Southeast Asia, for example, they have reasonably well-developed banking systems of their own. And you don't want development finance money to be used to compete with local banks. It gets us back to a previous question of, we've got to be very clear that development finance should be used to provide capital where it's not otherwise available, and that's usually in the most difficult places. Investment teams always follow the path of least resistance. They'll always look at what their guardrails are, and this is quite normal human behavior. They'll figure out how to deploy the capital within those guardrails in the lowest risk, most advantageous, easiest way. And that is going to come at the detriment of many of these smaller countries, lower income countries.
Nick, you mentioned that you're starting a senior fellowship at the Harvard Kennedy School. What do you hope to achieve through that academic engagement, and what themes are you planning to explore there?
The requirement is to produce a piece of research, a published piece of research over the year that I'm in residence, I guess, at the Kennedy School. I mean, the area that I have indicated I'm interested in is this one we talked about before. It's about how development finance institutions are integrating climate into their portfolios, how that's changing their strategy and their asset allocation. And it's about the question of whether or not that's getting in the way of their traditional mandates, because these are organizations that, if you go back even 5 years, had just one mandate, which was to support development. How can we reconcile, make sure that those are being properly balanced between development and finance institutions? That's the broad theme that I'm hoping to explore. And then obviously as a fellow at the Kennedy School, you do a little bit of teaching, and you do spend some time with the students and so on. So I'm looking forward to doing that.
So in 2022, you were awarded the CMG, the Companion of the Order of St. Michael and St. George, which is essentially for non-British subjects, means you were knighted for your contribution to impact investing. So becoming a knight, that's quite an honor. So congratulations to you.
It's not a knighthood, Scott. I'm sorry to tell you. It's actually, a knighthood would be one notch above. We have in the UK this very arcane list of sort of honors that people get for doing which government award, or I suppose the Royal Family Award. And there's a very clear pecking order. So I am not at the knighthood level, so you don't have to call me sir or anything. I'm a level below that.
But it's officially a knight, isn't it?
Oh, no, it's not. There's a pyramid of awards. My award is, one notch below a knight.
So all that work you did learning to ride horses and fight with swords, you didn't need that.
No, I didn't need that. Wasted time.
Well, congratulations. But how does that come about?
We have honors lists in the UK twice a year, once for the New Year and once for the Queen's or King's birthday. And then there's, as I say, a pyramid of different levels of seniority. And there's a whole office, I believe, in government that sifts all these applications and nominations. You get nominated and then they award them based on that.
I've got a few last rapid fire questions to wrap up our talk here. And just give me whatever comes to your mind, or if nothing does, feel free to take a pass. That's okay too. But if you had to name the single most important challenge in the impact investing space at this time, what would it be?
Yeah, I think the single biggest challenge in impact investing is still the same as it was the day we all got together and sort of came up with a term. And that is it's consistent, verifiable impact measurement. We've come a long way, but there's still, I think, a challenge for participants in the impact field to really articulate clearly what impact they're creating. And I think that also makes it difficult for us to articulate our real successes.
After 30 years in traditional finance and 15 years in impact investing, complete this sentence. If I could go back and tell my 25-year-old self at Goldman Sachs one thing, it would be what?
I think it would be to be more aware of, I think we got there in the end, but I think if I'm talking about 25-year-old self, I think to be less focused purely on the sort of economics of investments and have this broader view that goes across both, to think more about how the investment decisions that we're making and the asset allocation decisions we're making are having a real effect on people's lives.
What do you know now about impact investing that you wish you knew when you first started in the space at around the time at JPMorgan in 2008?
I think how complex it is. And I think this is part of the challenge for the whole community. We're so ambitious in terms of creating impact that we make, and blended finance is a great example of this. We make things incredibly complicated. We favor complexity at the expense of standardization, whereas I think the financial markets are very good at emphasizing standardization rather than complexity because they're focused on how much money they can make. We're focused very much on the good that we can do. Somehow getting that balance, we need to sort of rebalance that a little bit, less allowing the perfect to be the enemy of the good and more focusing on standardization. How can we standardize and maybe be less than perfect, but still get real scale?
This is an investor podcast, so I always ask these questions. Everyone at the club in Mayfair always likes to talk about their investments, how smart they were and how brilliant they were that they saw this. But in this case, you don't have to name names, but can you describe an investment that you were convinced at the time you invested, it ticked all your impact boxes, but in the end, it didn't turn out and went pear-shaped? And what was the lesson learned from that experience?
I go back to that investment in the DRC. I mean, it ticked all our impact boxes in a major way, but what we missed out was that financially it just wasn't viable. And so at the end of the day, I don't think that's the role of impact investment. It has to be sustainable. And there is a point at which no matter how great the impact, it just, as an investment, it just doesn't make sense.
Do you think, based on your learning now, if you're in this identical situation, all the signs were there that it wasn't viable? Because shit happens. There's always stuff that comes out of nowhere that you can't foresee. But do you think if you knew what you know now back then, all the signs were there and you should have backed away?
Yeah, we wouldn't have done that investment either. When I left BII, we wouldn't have done that investment under our current investment process because there were too many red flags. And I think it doesn't mean to say that somebody shouldn't have tried to keep the company going, but it shouldn't have been actually a development finance institution. It needed a different type of grant support than the type of funding that we tried to provide. And I think there were lots of red flags, lots of warning signals that we would be much more aware of now than we were then.
Now, the converse of that, can you describe an impact investment that you had some level of skepticism either at the time you invested, or maybe you were so skeptical you ultimately passed on it, and in the end, it turned out way better than you thought, and you were really pleased you invested? Or if you had passed on it, you wish you hadn't, and what was the lesson learned from that experience?
Some of the investments where I've been perhaps a little bit skeptical have been in agriculture. Has always been a big theme for development finance and for impact investment. It's a very difficult area to invest in, particularly primary agriculture and small scale farming. I think by going further up the value chain, we've invested, for example, provided capital to some of the trading companies. And I think what you learn from that is that you can't let the perfect be the enemy of the good. If by investing along the supply chain, you're not reaching maybe the small scale farmers directly as you would be. I think by investing along the supply chain, whether that's providing easier trading for their goods or whether that's providing funding for processing that's done closer to the point of production, those type of investments can make a huge difference. And we've done a number in places like Sierra Leone and Ghana. We've done a number of those, which I think have been more successful. I think I was a bit, as I say, skeptical going in, but have been more successful than I thought.
But was the lesson learned, don't let perfect be the enemy?
I think that is, yes, that is. And I do, as I mentioned, when we were talking about complexity, I think we do have a habit of letting the perfect be the enemy of the good. And if you do that too sort of rigorously, you get nothing done.
And if someone wants to get into the impact investing space, and I'm pretty much talking about someone substantially younger than you and I are, where would you advise them to start, or how would you advise them to cut their teeth?
I usually answer this question by saying, look, I think what the impact investment community needs is people that either have strong financial backgrounds, so they know how to do financial analysis, they know how to build models of companies, they understand what risk looks like. You need those skills. And then you need skills in terms of understanding the issues that we're trying to solve. And again, I'm thinking more about the developing world here, the issues that we're trying to solve, whether that's in agriculture, or whether that's in health, or whether that's in infrastructure, and the impact that can be created. What type of investments or economic activity creates real impact and what doesn't? If you're a young person, I know people coming out of university and they desperately want to do a job that is impactful from day one. Okay. And they feel almost guilty if they go off and work for JPMorgan, or they go off and work for Unilever, or whoever it is. But you've got to remember, you've got to learn the skills. There are a limited number of entry-level jobs in impact investment. BII, one of the things I did when I was there was set up a graduate program. So we take 12 people or whatever it is, 6 to 12 people a year, but they're very few and far between. The number of people that apply for them is thousands. Your career is a marathon. It's not a sprint. You got to learn to be patient. To me, it happened by accident, I suppose, because the impact investment world didn't exist when I started. Today, the best thing you can do if you want to build a career in impact investment is build real, substantial knowledge of either the financial or impact, so we can put them together later on.
You got to know the rules if you're going to break the rules.
Yeah, and you've got to know what good looks like. And in impact investing, I think there's a lot of very well-meaning people who are very focused on impact, but they don't recognize that there has to be the financial rigor and discipline around it as well. And those type of organizations typically don't attract in the long-term capital. So you do have to have both skills.
Nick, you've been very generous with your time today, and I've really enjoyed the conversation. You've got a lot of great stories to tell. You've had a long and impressive career, and it sounds like you're not done yet. That's the great thing. The Harvard Fellowship, the main thing you'll be doing in the immediate future, or do you have other things going on?
I've joined the board of Equity Bank, which is a large bank in Kenya. So I'll be obviously staying on that board. I'm doing some advisory work with African infrastructure investment and development firm, doing some advisory work with McKinsey, a couple of other things. I certainly, in terms of having a base, that's where I'll have a base.
And I don't know if there's a way people can follow you or find out different things that you're doing. Do you have a website, or is it on LinkedIn, or what?
No, I think LinkedIn is the best way to, I have 12,000 followers or something on LinkedIn. And so my communication has been a bit sporadic, I must say, since I left, but that is the best way.
And the best way, if someone should want to reach out to contact you, also LinkedIn, or?
Yeah, that would be the best way.
All right. Well, Nick, thanks again for coming on. Appreciate it.
Thank you, Scott.
All right. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.